Good afternoon, federal viewers. We have with us Chartered Accountant Ankit from PICE. So PICE is a fintech that makes GST filing simple for small businesses like grocery stores and pharmacies. But today he's going to talk to us, regular folks, salaried professionals, as to what we can expect this tax season. So I want to start off by asking you, the new ITR2 form has more granular detail, especially around capital gains and buybacks. So what's changed, and how can retail equity investors ensure that they're compliant?
Hi everyone. Hi Rachel. So basically, this year, not only at ITR 2, all the ITR, even ITR 1 is asking more details compared to last year. So basically, what income tax department want, ki everything related to your investment or like income, they want a particular details or everything related to it. For example, the ITR 2 earlier, that was not like disclosure of ISIN code and script-wise details for the equity was not required earlier. But now, what is the case? So we have to mention every like ISN codes and script-wise details for capital gains. So earlier even buyback, which is considered as tax efficient, right? But now what is required? So like every script-wise details. That means everything. For example, you have particular. For example, particular share you got on particular date, right? You have to mention that date and the number of shares and the value of the shares. Kind of script-wise details they wanted on ITR2. So this will help you. This will help department to cross-check with the you can say registrar or a broker. So they can directly cross-check with the like any authorities, related authorities. So this will be like currently every ITR filer or every entity have to little bit caution about it and have to
Sure.
share the have to share the particular details about it. So for example, even if we talk about ITR one earlier, when ITR one we are filing, so basically, investment details. We, for example, if you know that at 80C, right? 80C is related to deductions. Earlier, what we used to do, like for example, 1.5 lakh is the limit for 80C. So we can directly mention 1.5, right? Without mentioning the LIC number, LIC policy number, or like any particular investment details. But this year, they want like LIC policy number. For example, if you are claiming medical health like premium, then only they also like require a health premium policy number kind of thing. So basically, they want a basic details related to what you did, kind of thing. So they are like right.
And what about like foreign income disclosures, like NRIs or people who are having freelance income from overseas? Are they likely to face more scrutiny from the government?
Sorry, you're not audible.
Likely. So NRIs or people with freelance income from overseas, are they likely to face more scrutiny this year?
Yes, so this is happening like since 2 3 years when AIS all income statement came, right? So starting from it, all the incomes, it is directly connected with the PAN card. It is coming on that if you are missing that particular income, for example, if you're not shown a particular income on that ITR, right? Your AIS or that 26 AS or something, some documents will will have the details. So you have to like basically mention it. You can't like hide any income anymore, kind of thing. So
And what about the cost inflation index? It has been raised to 376. So can you explain how this affects long-term capital gains for someone selling property or maybe shares this year?
so basically, yeah, recent bill, you can say 2025 or 2024. So so updated as per updated one, you will not have a benefit of cost indexation since 23rd July 2024. So basically, any property if you bought before that particular date, that will be eligible for indexations. Otherwise, after that, property will be not eligible for this indexation. Okay, so if we will talk about the before, if you bought a property before that, right? So if you bought the property before this 2024 July, so you will get the benefit of indexation. How indexations will work? It is basically lower your LTCG. So for example, I can explain it somewhere. So basically, if you bought a property, for example, in 2005, right? Uh, so uh, uh, so during calculation of LTCG, we will not calculate your cost on 2005 and to selling price on 2025, right? So what we have to do, that indexations of 2025, we have to calculate that cost as on date. So how we will calculate that indexations of that 2025 in and we will calculate considering 376. For example, current year is 376, right? So your cost will be enhanced. So how it will help you to reduce? So basically, when your cost will be reduced, so total profit. So always LTCC is based on profit, right? So your profit will be reduced, and your profit will be reduced, then your LTCC, that capital gain, will be on lower side.
Right. And also another change that they've introduced is they want to do away with AY. All of us like are so this about the assessment here, which one it is. But apparently now we are going to move to a single tax year. So can you tell us how this will impact
It will, so
and
basically
if
it will
there are
not.
benefits to a single tax year?
Yeah, so it will not like majorly. It was just a term. So basically, first before that TTC 2025, we will used to have financial year and the assessment year. Assessment year in which we do assessment of that financial year. So there is a term, like for example, assessment financial year is 23-24, right? Then assessment year will be 24-25. Next year will be considered as assessment year. So as per the TTC, only 1 year will be considered. So financial year and assessment year will be one, right? It will be like not majorly impacting on anything related to like income tax, or it will be help like retail or like newcomers to understand that only 1 year, and it will help you to like reduce like not as compliance, but
They're saying
easy
it's
to
going to be less
understand.
confusing.
Yeah, easy to
Right.
understand.
Okay. So I have one last question for you. The CBDT has apparently recovered rupees 20,000 crore in pending dues. So does this mean we're seeing a tougher and more strict tax regime in place for Indians?
Not as such. So basically, this 20,000, we should not consider as a number. This is just a signal, like India's like tax authority are going into like small details. You can say like new phase of income tax in which like technology, surveillance, and AI is helping to de-earth anything which you are hiding or anyone is hiding, kind of thing. So their target
But
is, I
isn't
think, 1.9.
usage of AI, isn't the usage of AI, like for instance, they're proposing even including personal devices like data access rights. Is that something alarming from a privacy standpoint?
Earlier also income tax had like in some provision they can access your personal device, but this new thing we have to like check because earlier under multiple provision like section 132 or like for forensic imaging and other authorization demand and something kind of it, income tax department has a right to access our personal devices. But this we have to check because no clear boundary will create some problem for like individuals, right?
Okay. So the tax man is definitely coming after you. That's what we can hear it loud and clear from
Right.
Ankit. So thank you so much for joining us. Okay.
Yeah, thank you, Vijay. Thank you.
Sure.